Why is everyone talking about a market crash? Here's the truth. Market crashes happen. They always have and they always will, but guess what? They're a completely normal part of how the market works. Every single time stocks take a nosedive, you'll see the media blasting out headlines designed to make you panic. Why? Because fear gets clicks. But let's look at the reality. The market has dropped dozens of times over the last 100 years, and every single time it has eventually recovered and climbed to new all-time highs. The warnings about the next big crash never stop because there's always something to be uncertain about. So, what actually causes these crashes? It usually boils down to one of three things. First, economic shocks. Think recessions, sudden interest rate hikes, or global events that disrupt everything. Second, good old-fashioned investor panic. This is when people start selling off their investments simply because they see everyone else selling. It's a herd mentality that feeds on itself. And third, speculation. This is when asset prices get hyped up way beyond their actual value, creating a bubble that eventually has to pop when reality catches up. So you see, a crash isn't the financial apocalypse. It's more like a reset. Think of it like a forest fire. It's painful and destructive while it's happening, but it clears out the old dead wood and makes way for fresh, healthy new growth. If you're investing for the long term, say for retirement or a goal that's years away, a market crash does not have to be your enemy. In fact, it can be a massive opportunity. When prices fall, long-term investors don't see a disaster, they see a sale. It's a chance to buy more shares of great companies or funds at a discount. And then when the market inevitably recovers and prices rise again, those shares you bought on the cheap become even more valuable. So instead of reacting with fear and selling at the worst possible time, the smart move is to focus on your plan. What does that look like? First, keep investing regularly no matter what the market is doing. This strategy is called dollar cost averaging, and it's powerful. Second, make sure your portfolio is diversified. Don't put all your eggs in one basket. Spread your investments across different funds or ETFs. And third, a piece of advice that will save your sanity. Avoid checking your portfolio every single day. It will only stress you out. Remember the golden rule of investing. Time in the market beats timing the market every single time. So the next time you see those scary market crash headlines, just take a deep breath before you panic. Markets will always rise and fall, but in the long run, patience and discipline are the true keys to building wealth. You've been watching The Knowledge Harbor. If you found this helpful, subscribe and stay anchored as we explore how money truly works.